Hi, good morning, everybody. I know that everybody's looking for some good news right now, and I've got some good news, and everyone's been asking about what's going on with the market second half of this year. And so I'm happy to say that I do have some good news for everybody. Green, I found a great presentation from the Mortgage Bankers Association, which is a collection of all of the different banks in the United States. So what they do is they collectively pool information, and they're able to make predictions and reports for all of the lenders. It's a service to all the lenders. They share the data, and then they're able to make predictions and help the industry. What they're saying, I know you've heard about a V-shaped recovery, and that's exactly what the Mortgage Bank Association is predicting. What does that mean? That means that the losses from Q2 should be recovered in Q3, Q4, or Q1. They're looking at maybe one of the best three-quarter runs that the country has ever had. That's what they're predicting. So this is really great news for all of us. Low rates should be maintained for the rest of the year, as the Fed rates anticipate to stay low for the next 3 years, and definitely until the end of the year. And you'll see increasing values, which means it's a great time to take advantage of a housing market in the second half of this year. It's a great time for home buyers to take advantage of low rates and increasing values. Just to tell you a little story of how we got into the situation where we're currently in, we came into the year with more equity than we've ever had. Since 2011, you could see that we've been growing our equity. That's that solid line there. This dotted line is our debt. And so we've been paying off our debt, our real estate debt, and we've been generating real estate equity, which made it a perfect time for people to tap into their refinances. With rates lower than ever in March, you could see the total number of MBS loans that were purchased on a daily basis soared in March. March 20th, they had the highest amounts in years on a daily basis. And so there was a huge demand, and what this caused is the Treasury index to drop significantly in March. It's then returned back to a little bit more of a stable number. And what basically happened is, there was a huge demand, so the government had to issue T-bills in order to accommodate the demand. And the values dipped down, but then returned to normal. This is refinance activity. You can see the refinance index in red and the purchase index in blue. This is the rate index, where they look at refinances. There was such a surge in refinance opportunities in March. The refinance index dipped above the purchase index, and now it's a little bit returned to more normal variance between the two. The Fed reduced their funds rate to 0, and it's anticipated for 2020, 2021, and 2022 that they'll maintain this. And why is everyone so bullish? Well, it's because of this Stimulus Act of 2020. It's more than the Stimulus Act, the Economic Stimulus Act of 2008 and 2009 combined. And so they're very bullish. So let's jump right into the forecast here. You can see GDP growth was steady in 2018, 2019. We're going to take a dip in 2020, and then you'll see that grow back in 2021. Inflation slightly shortened for the time period, but returning back to normal in 21. The Fed funds rate, which we know is actually at 0. And then you see the 10-year Treasury slowly gaining momentum and increasing. And what does this mean for the 30-year fixed mortgage rates? Well, they're going to continue to stay low, which means it's still a great refinance market. What really matters to everybody are home sales, new home sales. And what they're actually predicting in 2020 is that we're going to have a better year at the end of the year when we count everything up from all the different quarters. We're going to have a better year in 2020 than in 2019.
In new home sales. Again, new home sales or new construction will be stronger in 2020 than it will be in 2019. Existing home sales is going to be level or slightly down for 2020, but increasing in 2021 and 2022.
I do believe if they're looking to see this pop in Q3 or Q4, New York is going to be lagged. These are national numbers, and so you have to take that into consideration. So if we were hit by, if we're going to be opening up, 3 months or 2 months or a month behind everybody, we probably can anticipate that we're going to see our boom behind. But the rest of the country is going to really boost the market and keep us afloat. So I think it's great that parts of the country are actually starting to open where they can, where it makes sense, where they've seen the curve really dip down. And that's going to help us out in the long run in New York, because we'll be just behind them. And other markets will be an indicator of what's going on in our market. So it would be kind of nice to see some return to normal in some of these states. Existing home sales, you can see it's going to be a great year in 2021, 2020. And purchase originations continue to be strong, continue to grow. That's a reflection of purchase transactions. And then refi originations, you can see really took a large increase in 2019. 2020 is the year of the refinance, and those loan officers that have built their businesses on refinances at banks like Wells Fargo and Chase are going to have to rebuild their business. Their cheese is getting moved. And in 2021, we're going to see refinances really dip down. And that's because everybody who could refinance is going to take advantage of the fact they could this year. And we're just not going to see as many people with the need to refinance going into next year. Here you can see in blue the refinance numbers, refinance units. In red, you can see purchase. This is following, again, the purchase market, the real estate purchase market, which you can see from 2011 to 2019 really steadily increased. And in 2021, 2022, they continue to increase, but you can see the refinance years here, where 2012, they were 2016 was another year of the refinance, 2019 and 2020, but not 2021. People are going to have already refinanced by then. When we polled and asked buyers who are on hold right now due to COVID, when they asked buyers and sellers how they felt and what their reactions were, and 60% said that they were delaying a couple of months. That's great news. Those are buyers that are going to come back onto the market. 12% said that they're going to continue the process but relying on virtual communication. 12% said that they're deciding to not buy or sell. And 10% said that there was no change. And 10% said that they're undecided at the moment. So that's really great. That just tells us that there's this pent-up demand, that a bunch of home buyers that are looking to restart the process in the second half of this year and make up for the losses that we had in the last quarter. This is showing all of the sellers that were polled, and they have similar results. So buyers and sellers feel the same way. They're just put on hold, and they're going to continue resuming their purchase or selling transactions. And how does this affect us? Well, I recommend that everybody gets ready. I recommend that us at Hudson United, the loan officers, get ready for low rates, increasing values in a great market. Think long term. You can do the work now. For the work that you put in now are going to be closings in Q3 and Q4. And if you haven't built your pipeline now, if you haven't adapted to this market, it's not too late. It's like halftime. We've been in this situation now for about a month and a half. Probably realistically have another month and a half to go in this case. Who knows? Maybe how much of the virtual tools we'll be using for the remainder of the year or forever. And so, it's not too late to adapt and build your business now. Those that market now will be remembered in the future. And I think it's a great time to do that. Hudson United is prepared. We're building our net. It's a great time to be a non-captured lender. We're able to identify of the 30 different banks who's moving their pipelines right now, who's funding, who's giving great rates, and who's stalling, creating issues. Obviously, forbearances are an issue for all lenders, and also job losses are an issue. And so if you've got home buyers that are going through the process right now, you want to recommend to them to not take advantage of the forbearance. It may disrupt their credit in the future. It may disrupt their opportunities to purchase in the future. And so we're strongly recommend. It also creates all kinds of issues for the bank and the bank pipelines when they claim forbearance for a loan that was just originated. So for your new home buyers, we're just recommending that you advise them not to take advantage of the forbearance. However, we're able to manage that. We're a broker and a lender, and so we've been able to hedge our risk and move the files to the banks that are moving the files right now. So it's really a terrible time to be at a brick and mortar captured bank environment. They don't have a product that they're able to lend right now in some cases. You've seen tightening guidelines. And so for those that are at captured banks right now, we're offering the ability of sponsorship for them to get their state license, because they are federally chartered licenses. Right now, actually, since last year, they changed the law in that you're able to transition from a federal license to a state license. And so this is the first 12 months that this has been in effect. And so now I think you'll see a lot of talent coming from the captured loan officer environment to a non-captured environment like Hudson United. And we've really been on top of our Zoom accounts. We've switched to virtual closings. You've seen that in the title company and the mortgage company. And now we're encouraging virtual pre-approvals, virtual refinances. It's now easier than ever to get an appointment with our loan officers, to get in touch with them face-to-face, to be able to take advantage of the market right now, either for a refinance or to build your pipeline for the second half of this year. So as you have people coming into your virtual open houses, please send those lists over to your loan officer. They're more than happy to make phone calls and try to qualify those lists with you and break up some of those costs, because I know that you're getting a lot of attention on your virtual open houses, which is great. And we're here to help you with virtual pre-approvals and virtual refinance consultations. So just want to leave everybody with a quote. We're saying that champions are made in the off season. It's a popular quote. And so, the work that you put in right now is going to pay off, and it's going to make us champions by the end of the year.